Interest rates are the primary focus of our real estate market today and the primary focus for the overall economy. If you think mortgage interest rates are going higher right now, then you might be surprised by the content of this video. I'm going to show you how to navigate mortgage interest rates in an inflationary environment. Let's take a look. Friends, to know the inside game, you really got to follow the money. There are certain areas of the stock market that will expose this. With that, we're going to go to the charts. Okay, guys, I've shown you this chart before. This is just going to give you an outline of my recession trend line here, as well as our trading channel from 1994 to today in 2022. So to preface, our inflation rate today is 8.6%. The government has two choices when it comes to lower inflation. One, they can increase supply, or two, they have to lower demand. They've chosen to lower demand by raising the federal funds rate, which they have done already 3 times this year. Now, as we get deeper into this inflationary environment, the economy will come to a fork in the road. We're either going to go down the path of hyperinflation, which is where mortgage interest rates will continue to go up and trend up with the federal funds rate as we see here in the 1980s, or we can go down the path of a recession where mortgage interest rates will diverge and go in the opposite direction of the federal funds rates, rendering lower interest rates like you can see here in 2003 and in the recession of 2007 through 14. I'm going to expand the chart here and show you where we're at today, okay? Now, as you can see, we broke out of the 1994 trend line. We head up, and I'm going to just expand this area here. So I'm going to magnify this area right here. So now that we see this blown up, what you're going to see here is a vertical line that is dotted. That is going to show you the dates on both charts. On the right side of the chart is the federal funds rate. You can clearly see the 3 increases that we've had so far this year. 1 here, 2 here, and 3 here. Okay, so a 1/4 point, a 1/2 point, and 3/4 of a point here. So 3/4 of a point, it's a big move. The last time they raised the federal funds rate 3/4 of a point was in 1994. So what I really feel is showing us clear direction now that we're going more towards a recession instead of hyperinflation is that looking on the left side of the chart, you're seeing the 10-year note. And right here, you're starting to see this drop. See right here? And it doesn't really hold, comes down, hits our recession trend line here, tries to bounce back up, but it gets denied and it breaks through this technical level here that it tried to hold. It also broke through this 50-day moving average, which you can see here was support. When it tried to pull back after the 50 basis point increase, it bounced up. Now here we broke through that support as well. And there's one more item here that you'd want to take a look at, and that is the short-term moving average here is crossing over our long-term moving average, which is also showing that there's possible more downside move here. So for mortgage interest rates, from a technical perspective, are now coming down. Also, what's contributing to that is, we've talked about this in my last video as well, is this 10-year, 2-year crossover. So what this is showing you is that short-term interest rates are almost crossing over long-term interest rates. Once that goes negative, that is also a technical signal that you're in a recession. And right now we're 0.04 away. 0.04 from hitting negative, a negative crossover on short-term interest rates. So that is also something to keep a close eye on. Okay, so now we're going to go back to the original chart, and here we are where we were just looking at it magnified, and I'm going to blow this up. And what you want to see happen now, as we've had this breakout pop up and fail and come back down, we want to see it pull back under this blue line here. And if this can pull back under this blue line and hold, it's going to be really amazing for interest rates, because look what happens since 1994 in our trend here. Every time we hit the top of this trading channel, you come all the way down to the bottom. So here at this green line here, or this green arrow, you hit this in January 2000, you come all the way down. You hit the top of this trading channel in June of 07, and you pop all the way back down. You hit the top of the trading channel in October 2018, you pop all the way back down. So if we can get back under here and hold, there's an awesome potential via another recession, we pop all the way back down to here. And here's the interesting thing to note as well. Every time we have these economic events, we go lower. Here, we go lower again. We continue to make what's called a lower low. So interest rates could possibly, if we hit the bottom of this channel, will be lower than they even were during COVID, as illustrated by this historical trading channel that has been established from 1994 to 2022. That's a lot of history. So everything that I've talked to you about so far is all based on technical analysis. Technical analysis is just a high or low probability setup you're identifying based on the chart analysis. Where I think you're going to get momentum to the downside with these mortgage interest rates is with fundamental news. That is news that can move the markets lower. For example, there has been nationwide layoffs since the beginning of this inflationary environment. But this week alone, we've had layoffs announced by Tesla, Facebook, and Ethos. Also, you're having poor forward guidance in all semiconductor markets, tech stocks, car manufacturers as well. And this means they're revising their outlook by lowering their future expected growth in sales, with the latest being Micron Semiconductors announced on Thursday. Subscribers are falling off as well from large companies like Netflix, Peloton, Roku, a merriment of ISPs as well as cable providers. And, the big crisis also out there is gasoline prices, which based on the G7 summit in Madrid a few days ago, Biden announced that Americans are going to have to get used to higher gas prices as long as the war in Ukraine continues. You have Saudi Arabia and OPEC increasing production, but it is not enough to bring gas prices down in the United States. So this continues to put pressure on the consumer with regards to spending behaviors. So 2 dates you want to keep an eye on coming up here. That is July 26th or 27th. They're going to raise interest rates another 75 basis points. That's the federal funds rate. We should see mortgage interest rates come down based on that movement. The second report to keep an eye on is the gross domestic product report that is coming out at the end of September. We already have one negative GDP report that came out in April. If the next one comes out negative in September, then you have 2 consecutive negative GDP reports, and then that will technically put us into a recession. So with that, we should see mortgage interest rates come down, but it's still a fantastic time to buy a house, and I wouldn't let this type of economic data detour you from making a great decision for you and your family. Gang, in conclusion, you're going to want to Google the 10-year versus 2-year. Click the TradingView link. That's the link I like the best. The lower that number is, the better it is for interest rates. If that number goes negative, that's even more fantastic. You're going to want to also watch ticker symbol TNX. That is going to show the overall direction of mortgage interest rates. The lower that is, the better it is for interest rates as well. But above all, give me a call because I'm always available to take your call, to review with you where this market is at. It is moving on a dime, so the more updated information you have, the more paramount that's going to be to your decision-making process, and we want to make sure that you're making the best decisions with the most up-to-date information. And if you're looking for a lender who can offer you low rates, availabilities, evenings and weekends, as well as making sure you have an awesome home buying experience, look no further. My information is below. Thank you for watching and have a great day.